What a bloodbath we saw in the Indian stock market today. Biggest loss since the corona times, where market witnessed back-to-back losses for almost 2 weeks. Welcome to India Trade Talk. Today, we are diving into the critical analysis of the 2024 Indian general election results and their profound impact on the financial markets. As the NDA secures a majority and the UPA nearly doubles its seat from the last election, the political dynamics in India have undergone a significant shift. However, this political upheaval has not come without consequences for the stock market. We have witnessed a dramatic downturn with major indices like Nifty, Sensex and Bank Nifty experiencing substantial losses. In this video, we will explore the immediate market reactions, shedding light on the reasons behind this sudden market bloodbath. We'll delve into factors such as uncertainties over future economic policies, fears of potential political instabilities, profit booking by investors, and the influence of global economic conditions. By understanding these elements, you'll gain a clearer picture of why the market has reacted so strongly. Additionally, we'll provide strategies to navigate this volatile phase, focusing on long-term investment goals and risk management. You will learn how to stay calm amidst the turmoil, identify buying opportunities in fundamentally strong stocks, and diversify your portfolio to mitigate risks. Join us as we break down the current market scenario, compare it with historical election impacts, and offer expert tips to help you make informed investment decisions during these uncertain times. Don't forget to like, subscribe, and hit the bell icon to stay updated with the latest analysis. Let's get started. Let's take a closer look at the 2024 Indian general election results based on the current count. As the counting progresses, the NDA, led by the BJP, has crossed the majority mark once again. However, they have lost nearly 50 seats compared to the last election. This reduction reflects a shift in voter sentiment and possibly some regional dynamics that have played a crucial role in this outcome. On the other hand, the UPA, headed by Congress Party, has seen a remarkable surge, gaining 106 seats. This substantial increase highlights a strong resurgence for the UPA, indicating that their campaign strategies and alliances have resonated well with the electorate. Other parties, however, are not faring as well, collectively losing around 56 seats. This redistribution of seats among the major alliances and other parties paints a complex picture of the current political landscape in India. These preliminary numbers, while not final, provide a snapshot of the evolving political scenario. As the counting continues, it will be crucial to monitor how these shifts influence investor sentiments and the market stability. The final outcomes could have significant implications for the economic policies and the broader financial market landscape. Now, let's dive into the market's reaction to the ongoing election results. Today, we have witnessed a significant downturn across all major indices. Nifty closed down by 5.93%, marking one of the steepest decline in recent history, while Sensex fell by 5.74%. The banking sector saw the most significant impact, with Bank Nifty closing down by a staggering 7.95%. Other sectors, including small caps, mid caps, oil and gas, energy and metals, also faced substantial losses, with declines ranging from 5% to 16%. This broad-based sell-off indicates a widespread reaction from investors who are adjusting their positions in response to the evolving political landscape. Several factors are contributing to this market bloodbath: uncertainty over future economic policies, fears of potential political instability, profit booking by investors, and global economic influences. As the election results continues to come in, it's crucial to monitor how these factors evolve and impact market sentiment. Understanding the underlying reasons for this sharp market reaction and considering these elements will help us navigate these challenging phases and make informed investment decisions moving forward. Several key initiatives were driving market optimism prior to the election results. These included ambitious plans in the various sectors such as railways, solar energy, public infrastructure, realty, oil and gas, shipbuilding, power, chip manufacturing, and the development of new airports. Investors were particularly bullish on the continued rollout of Vande Bharat trains and the proposed bullet trains, substantial subsidies to promote solar rooftops, and the extensive development of public infrastructure, including smart cities and better roads. Additionally, there was significant enthusiasm for the Make in India initiatives aimed at boosting local manufacturing, including shipbuilding and chip production. In the realty sector, the promise of housing for everyone in villages and a boost for private housing in tier 1 to 3 cities had garnered considerable interest. The oil and gas sector's initiatives to provide piped gas to every household and explore alternatives like ethanol for petrol and diesel were also driving positive sentiment. Furthermore, the commitment to providing power to every house and development of new airports and railway stations were seen as critical drivers of economic growth. However, with the election results now indicating a significant shift in the political landscape, there are growing fears about the future of these initiatives. Investors are concerned about potential changes in policy direction and the continuity of these ambitious projects. The market's sharp decline reflects this uncertainty as investors reassess the potential risks and adjust their positions accordingly. Understanding these fears and the reason behind this market reaction is crucial for navigating the current phase. It highlights the need for closely monitoring policy announcements and staying informed about any developments that could impact these key initiatives and consequently market stability. Now, let's examine the immediate impact of the election results on key sectors. The sharp decline across the market has not spared any major sector, but the intensity of the impact has varied. The banking sector has faced the most significant blow, with Bank Nifty closing down by nearly 8%. This drastic drop reflects investor concerns over the potential policy changes and economic instability that could affect the financial health of banks. Public infrastructure projects, which were a major driver of market optimism, have also been hit hard. The uncertainty surrounding the continuation of ambitious infrastructure initiatives, such as the development of smart cities and better roads, has led to substantial decline in related stocks. The realty sector, previously buoyed by promises of housing for all and a boost in private housing developments in urban and rural areas, has seen significant losses. The energy sector, particularly solar energy and oil and gas, has experienced a noticeable downturn. The market is questioning the sustainability of subsidies for solar rooftops and the push for alternative fuel like ethanol, which were expected to drive growth in these industries. Other sectors like shipbuilding, power, and chip manufacturing, all part of Make in India initiative, have also felt the pressure. The uncertainty over whether these projects will continue at the same pace has contributed to the overall market decline. This broad-based impact highlights the market's sensitivity to political and policy changes. Investors are re-evaluating their positions, leading to widespread sell-offs across sectors that were previously viewed as growth drivers. Understanding these immediate impacts is crucial for assessing future market movements and identifying potential areas of resilience or recovery. Let's put the current market reaction in Sensex index in historical context by comparing it to the previous election years. Looking back, we see that the Indian stock market has often exhibited significant volatility during election periods. In 2004, the market experienced an unexpected drop due to political uncertainty, catching many investors off guard. The 2009 election, on the other hand, saw a strong recovery post-election as the market reacted positively to the clear mandate and stable government formation. The 2014 election marked one of the most bullish responses, with the market seeing the highest initial surge in recent history. Investors who were optimistic about the economic reforms promised by the new government. Similarly, the 2009 elections resulted in sustained market growth, driven by continued confidence in economic stability and reform agendas. Comparing these past reactions to the current scenario, we can identify some common patterns. Initial volatility often gives way to recovery as political clarity emerges and policies begins to take control. However, the current market downturn appears more pronounced, reflecting deeper concerns over the continuity of key initiatives and potential policy shifts. By understanding these historical patterns, we can better navigate the current market turbulence. It's essential to remain cautious but also look for signs of stability and recovery as the political landscape becomes clearer. Historical context reminds us that while elections often bring short-term volatility, they also pave the way for new opportunities once the dust settles. Given the current market volatility and uncertainty, navigating this phase requires a strategic and measured approach. Here are some key strategies to help investors manage their portfolios during these turbulent times. First and foremost, it's crucial to stay calm and avoid panic selling. Market downturns, while challenging, are a natural part of the investment cycle. Historical data shows that markets tend to recover over time, so maintaining a long-term perspective is essential. Focus on your long-term investment goals rather than short-term market fluctuations. Review your investment strategies and ensure it aligns with your financial objectives. This may involve rebalancing your portfolio to maintain your desired asset allocation. Diversifying your investments is another critical strategy. Spread your investments across various sectors and asset classes to reduce risk. This diversification helps cushion the impact of downturns in any single sector or market segment. Look for buying opportunities in fundamentally strong stocks. Market corrections can present attractive entry points for quality stocks that are temporarily undervalued. Conduct thorough research to identify companies with strong financials and growth prospects. Consider defensive sectors that tend to perform relatively well during periods of market volatility. These sectors, such as consumer staples, healthcare, and utilities, provide essential services and are less affected by economic fluctuations. Stay informed about policy announcements and economic indicators. Understanding the evolving political and economic landscape can help you make informed investment decisions. Regularly reviewing financial news and reports will keep you updated on market trends and potential opportunities. Lastly, consult with a financial advisor to tailor strategies to your specific needs and risk tolerance. A professional can provide personalized advice and help you navigate the complexities of the market during uncertain times. By employing these strategies, you can better manage the risks associated with market volatility and position your portfolio for potential recovery and growth. Moving forward, it's important to maintain a sense of trust and confidence in the long-term prospects of India, or as is often referred to, Brand Bharat. Irrespective of whom we might see as the next PM, the fundamental strengths and growth potential of India remains robust. As NDA secured the majority, it seems like BJP will form the government and we will see Narendra Modi's third term, which will ensure the continuation of current policies. We are on a clear path towards becoming a $5 trillion and third largest economy within the next 5 years. This vision is driven by the resilience and dynamism of the Indian economy, which continues to attract global attention and investments. Although the formation of a coalition government may introduce some complexities, particularly in making bold policy decisions, the overall direction of economic policies and development initiatives is expected to continue. Mr. Modi's continuity is crucial for ongoing projects and initiatives that are pivotal to India's growth trajectory. Investors should remain optimistic about the long-term growth story of India. The ongoing commitment to infrastructure development, digital economy, and various Make in India initiatives will likely persist, fostering an environment conducive to economic expansion and innovation. In navigating this phase, it is essential to keep in mind the resilience and potential of the Indian economy. Staying focused on the bigger picture and long-term objectives can provide a buffer against short-term market fluctuations. Let's now discuss some key points we can consider while selecting and trading stocks for the long term. It's essential to follow a set of well-defined technical rules to minimize risk and increase the likelihood of success. Here are some key technical ideas to consider. Firstly, stocks trading near their 52-week low often indicate poor performance or unresolved issues. By avoiding these stocks, we minimize exposure to potentially problematic investments. Next, the 200-day moving average is a critical indicator of long-term trends. Stocks trading near or below this level are generally in a downtrend and should be avoided, as they may continue to underperform. Next, short-term moving averages are prone to market noise and can lead to misleading signals. Focusing on longer-term indicators help in making more stable investment decisions. Derivatives such as options and futures can add significant volatility and complexity to a portfolio. During uncertain times, it's prudent to avoid these instruments to reduce risk. High volume during a stock's decline suggests strong selling pressure and potential further downside. Avoiding these stocks help protect against significant losses. Long-term support levels provide more reliable entry points for swing or reversal trades. These levels are less susceptible to short-term fluctuations and can offer stronger price stability. The 50-day and 200-day moving averages are effective tools for identifying long-term trends and potential reversal points. Using these indicators can help pinpoint more accurate and reliable trading opportunities. By adhering to these technical rules, you can create a disciplined approach to stock selection and trading that prioritizes long-term success and risk management. This strategic focus on long-term indicators and support levels helps navigate market volatility and position your portfolio for sustainable growth. In conclusion, navigating the current market volatility and making informed decisions for long-term stock selection requires a combination of technical and fundamental analysis. By focusing on key technical indicators such as avoiding stocks near their 52-week lows or those trading below their 200-day moving averages, and emphasizing long-term support levels and moving averages for swing or reversal trading, investors can better manage risk and capitalize on growth opportunities. Fundamental analysis remain equally important, ensuring that the selected companies have strong financial health, competitive advantages, reasonable valuations, and effective management. Combining these technical and fundamental approaches help create a balanced and informed investment strategy, allowing for more confident decision making in uncertain times. Remember to stay calm during market fluctuations and maintain a long-term perspective, and diversify your portfolio to manage risks effectively. Keep an eye on policy announcements and economic indicators to stay informed about the market trends and potential opportunities. Consulting with a financial advisor can provide personalized guidance tailored to your specific needs and risk tolerance. Finally, thank you for joining us. Please note, we are not SEBI registered analysts. These views are personal and for educational purposes only. As discussed, please consult your financial advisor for any such decision.